Today, Ether drops to end the week. Do Kwon is sentenced to 15 years behind bars. And Frank Salla, the president and CEO of the Depository Trust Clearing Corporation, explains the no-action letter it received for its tokenization services program. Welcome to CNBC's Crypto World. I'm Brandon Gomez. Crypto prices are mixed to end the week, with Bitcoin climbing slightly and holding on to the $90,000 level. Ether dropped more than 3%, and XRP traded pretty flat, all as of noon Eastern. The moves for crypto come as U.S. equities pulled back this morning. Investors continue to pull out of tech in favor of value areas of the market. For the week, Bitcoin and Ether are both in the green, climbing under 1% and nearly 1.5% respectively. XRP, however, is in the red, falling under 2% in the past 7 days. This week's moves come after the Fed on Wednesday issued its third rate cut this year. Okay, let's kick things off with an update to a story we first brought you yesterday. Do Kwon, the co-founder of Terraform Labs, the company behind the failed algorithmic stablecoin Terra USD, was sentenced to 15 years in prison for orchestrating a $40 billion fraud. The U.S. Attorney for the Southern District of New York, Jay Clayton, announced Do Kwon's sentencing yesterday for wire fraud and conspiracy to commit securities fraud, commodities fraud, and wire fraud. The charges brought by the DOJ centered around the massive collapse of Terraform Labs and its cryptocurrencies. Do Kwon pleaded guilty to those charges back in August after a lengthy effort to get him extradited to the United States from Montenegro, which took place last December. And just last week, prosecutors recommended a sentence of 12 years. That's more than double of his defense team's request of no more than 5 years. In addition to the 15-year prison term, Kwon was ordered to forfeit over $19 million in proceeds from his illegal schemes, including his interest in Terraform and its cryptocurrencies. Next, industry members are teaming up to promote safe access to prediction markets. The Coalition for Prediction Markets includes members like Crypto.com, Coinbase, and Robinhood, along with non-crypto members like Kalshi and sports betting platform Underdog. Announcing the coalition's launch today, the group says as prediction markets reached nearly $28 billion in combined trading volume through October, it's a critical moment for unified engagement. The group also argues 7/10 of voters believe prediction markets should not be regulated as gambling, and that 2/3 of Americans prefer federal-level oversight. Just yesterday, we told you Gemini plans to enter prediction markets. The crypto exchange announced its affiliate, Gemini Titan, received a license from the CFTC to offer prediction markets to U.S. users. This comes as more crypto companies look to embrace prediction markets to expand their revenue sources. That includes Coinbase, which told CNBC back in July that the firm also had plans to launch prediction markets along with other new products. Last, the SEC has given the okay to tokenize some stocks. That's according to the Depository Trust Clearing Corporation, or DTCC for short, which announced yesterday its subsidiary received a no-action letter from the SEC to offer a service for tokenizing real-world assets. DTCC says the no-action letter would allow it to offer this service for 3 years, and the tokenized real-world assets would have the same entitlements, protections, and ownership rights as the asset would in its traditional form. Now it adds that this includes the Russell 1000, ETFs tracking major indices, and T-bills. The firm says it plans to roll out the service as soon as the second half of 2026. Sticking with this news for our main story, Crypto World's Jordan Smith spoke with Frank Salla, president and CEO of DTCC, about the significance of this development and what happens next.
So, Frank, I want to talk to you about this letter from the SEC giving a no action in just a moment, but I think we should start by sort of setting the scene and talking about what this product is that DTCC is offering. Can you explain this tokenization service that you're piloting, the kinds of users that you expect to use it, and most importantly, why you want to launch this product right now?
Yeah. So Jordan, as you know, the securities industry has been moving toward tokenization for a number of years now. I think now that we're getting a little more clarity, especially out of Washington, in what's inbounds and what isn't, the industry is now moving at a pace to tokenize real-world assets. And if you think about assets as software, it's natural for the industry to begin to look at blockchain as the next generation of software to carry assets. And they could be financial assets. They could also be real assets like paintings and cars and all kinds of different assets. But we in the industry are obviously focused on assets. And what we saw at DTCC, because we sit in the middle of the financial services ecosystem, we hold $100 trillion in assets for the industry. We saw a number of different members looking to tokenize different sorts of asset classes. Some want to tokenize ETFs, some want to tokenize indexes. And we said, if the industry moves down in sort of in a dispersed way, it could ultimately hurt liquidity by breaking up assets. So because of our very unique position in the market, we said it's time for DTCC to begin the tokenization process at the foundational level, because we hold all of them. So the intention of the service is that as we go down a path in a very methodical and deliberate and thoughtful way, we will begin to tokenize many of the real world assets. And then that will make it available for the industry to allow them to run on different blockchains, L1s, L2s. So we will be the facilitator or the enabler for the industry to use those tokenized assets in a way that they think is best for them and ultimately their clients.
Yeah, as you mentioned, tokenization has been a growing trend on Wall Street in recent years, and you're a major player in the space. And you argued to the SEC that the agency shouldn't recommend enforcement action against this pilot program. What spurred you to make that claim? Was the goal to get the SEC to take a stance on this developing technology? Because I think there's a lot of open questions right now about, what is fair game when it comes to crypto right now. Obviously, there's a lot changing in the regulatory environment. So how are you thinking about engaging with the SEC in this new tokenization platform?
Well, whatever we do at DTCC, we are a highly regulated company, and the SEC is our primary regulator. So anything we do, we always engage with the SEC on. And we began these conversations a while back, and the SEC was listening, and they were receptive to what the idea was. So all we really wanted out of filing the letter was to get absolute clarity and certainty that we were on the same page with the SEC on what our intentions were. And we worked with them. They engaged with us. We laid out why we thought it was a good idea. And then they ultimately, after a lot of thought and a lot of discussions, came around and said, yeah, we will issue this no action letter and give DTCC relief to be able to do this, as a first step in what I think is ultimately the evolution of the financial services market.
The SEC did say that it saw no reason for enforcement action based on what you presented to them about this pilot. And you told the agency that these tokenized entitlements wouldn't have a collateral or settlement value. You laid out eligible securities, which I think is an important point of this letter. You said that this program would be mostly limited to the Russell 1000 index, treasuries, and ETFs tracking things like the S&P 500 and NASDAQ 100. I guess my question is, why did you choose those securities to start with? Do you think keeping this pilot limited sort of helped you move forward without any concern from the SEC?
Well, what I would say is this. The reason we chose the indices like the Russell 1000, which is one of the broadest swaths of equities, it's got large caps and small caps and mid caps. So it's got a very wide ranging set of securities within the index. And we also said ETFs. And the reason we landed there was because as we listened to the industry, that was what they first said they were very interested in beginning with. So again, being very deliberate and methodical, we thought if we were going to start somewhere, the Russell 1000 and the ETFs were the right place to start. And what we've said is, as that goes, and if it goes well, we will then continue to expand it out to other asset classes that we have. So again, we're taking a very thoughtful approach about, crawling, then walking, and then running. And this will be over a couple of years, but we do think it's the right place to start. And by the way, ETFs and indices by themselves really impact a number of investors. So one of the broadest holdings for most investors are those asset classes. And we thought it was natural for us to start there.
Yeah. To your point, I think that this letter does potentially open up a ramp of expansion for you. And I want to talk about that. Obviously, I should caveat that the SEC can change its mind as the industry and product offering evolves, both for your business specifically and others. But that this shouldn't be taken, I guess, as legal conclusions of any way. But it does seem like the agency is at least open to this approach of tokenizing securities. Talk about what this letter means for your business, and maybe dive a little bit deeper into how you see your ability to expand now with tokenized securities.
Yeah, well, obviously now that we've got the letter from the SEC, and again, you're right, it can change, but we are committed, and we always will work in lockstep with any of the regulators that we have to make sure that there's no difference between us and them, and we take that very, very seriously. But what it does allow us to do, as you rightly say, it now allows us to begin the tokenizing of securities. And as I said, I think this will allow us to do two things. It will allow us to begin on a journey of ultimately tokenizing all the asset classes we have that we hold for the industry, and make them blockchain accessible, which is really important. I think the other important thing is DTCC serves the financial services industry. So now with this relief that we get from the SEC, we could actually go out to our firms, our member firms, and have a much more engaging dialogue with them on what they see in terms of blockchain, what they think they need, what their clients need. And so it opens up a lane for us to be able to engage, experiment, and work with the industry in a way we couldn't do before, because now we have that regulatory clarity. So I view this as a first step, a major first step in the industry really beginning to tokenize securities in a much more meaningful way than it has up to this point.
What has the reaction from the financial services industry been, I guess, specifically to this letter and what your plans are to expand? I think there is a lot of excitement, as I mentioned earlier, from Wall Street about tokenizing securities, yes, and also assets broadly. But I think there are also still questions about sort of how to integrate blockchain into Wall Street, how sort of the inner workings of regulation for crypto and blockchain and Web3 technology, and how banks play into that. So what has the dialogue been like for financial services and you now that you have this response from the SEC? Well,
I think, what I would say is this. I think it's safe to say that the industry is still in a lot of discovery mode, right? The industry is getting comfortable with the technology, really talking about how it could be used in a beneficial way for end investors and for the industry, how it could potentially reduce risk. So there's a number of different aspects to this powerful technology that is very attractive. I also think what we're hearing from all participants in the industry is this is what investors want. They want the ability to choose between traditional classical assets held the way they are today or in digital form. And just the idea of being able to give investors the ability to choose and still maintain it safely, securely is crucial. And so I do think that now with the conversations we can have with the industry, we can then say, okay, what do we need to do? What are you hearing from your clients? And then what do we need to do to address the needs of the clients, but still maintain the integrity of the financial services system as it exists today? That's a big deal. The other thing is, you asked about going a little bit deeper. There are other second derivative aspects to this. Things like collateral movement. So things like tri-party repo, treasuries. If they are able to move on the chain, they can move much more freely in almost a 24/7 environment, which we don't have today. And that has huge implications for liquidity and for the banking system, which again, could be very, very positive. And those are the things that we're going to embark on and working with the industry on as we continue to move down the path of tokenization.
Okay, that's all for Crypto World this week. We're back again on Monday, and we will see you then.